Welcome back to the Deep Dive. Today, we aren't just looking at a company, we're staring up at a mountain, a $3.6 trillion mountain.
To put that in perspective, that's roughly the GDP of, say, France or the UK. It's just staggering.
We are talking, of course, about Microsoft.
Right.
The date is January 28th, 2026. And looking at the sheer scale of this thing, it doesn't feel like a software company anymore.
No.
It feels more like the digital operating system for the entire global economy.
That is the perfect way to frame it. I mean, they've successfully pulled off the rarest trick in tech. They transitioned from the Windows PC era, then they dominated the cloud era, and now they're effectively the infrastructure layer for the AI era.
But being big doesn't always mean being a good investment. Our mission today is to dig through this stack of reports, the earnings that just dropped, the 10-year analysis, the works and answers one. Very expensive question. Is Microsoft a perfect company, trading at a dangerous price?
It's the classic great business versus great stock dilemma. Just because the company is winning doesn't mean you should buy the stock at any price.
Exactly. And speaking of price, context is everything. Before we even dissect Microsoft, we need to know if the broader market is, manic or depressive.
Right. You can't judge the ship without looking at the ocean.
Precisely. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store. It's a great tool to see if the overall market is overheating before you make any specific bets.
Always good to check the macro weather. But let's zoom in. Microsoft just released their Q2 fiscal year 2026 earnings. What are the headline numbers telling us?
The numbers are massive.
Yeah.
Revenue came in somewhere between $77.7 and $81.3 billion for the quarter.
Just for the quarter.
For the quarter ending December 31st, 2025. That's a 15 to 17% jump year over year.
And for a company of this size, double-digit growth is like seeing an elephant sprint. It shouldn't be physically possible.
But here's where I need you to parse the details for me. The net income, the actual profit, jumped by something like 27 to 32%. That seems, well, disproportionately high compared to revenue.
It is.
Usually, profit grows more in line with sales, right?
You spotted the anomaly. That surge isn't entirely from selling software. A huge chunk of that profit, a $7.6 billion chunk, came from an investment gain related to OpenAI.
Okay, so that's basically the value of their stake in OpenAI going up on paper.
Exactly. It's a paper gain. It's an accounting rule. Last year, that same line item actually showed a loss. This year, it's a massive gain because OpenAI's valuation soared. It's great for the headline number, but
it's not real cash from the business.
right. As an investor, you have to mentally strip that out to see how the actual business is performing.
That makes sense. It's like saying my salary went up, but really I just found a rare coin in my couch cushions. It's nice, but it's not a raise.
Precisely. If we rely on that one-time gain, we get a distorted picture of their real operating power.
Okay, so if we ignore the $7 billion side hustle bonus, what's powering the actual engine?
It's the cloud. It is always the cloud. The intelligent cloud segment brought in over $32 billion, growing around 20%. But the real star of the show is Azure.
Their cloud computing platform.
That grew in the mid to high 30s, 34%.
Mid-30s growth for a platform that big is wild.
Yeah.
But why? I feel like we've been talking about moving to the cloud for 10 years now. Isn't everyone already there?
They are, but the usage has changed. This is the big shift from experimentation to production. For the last couple of years, companies were playing with AI, kicking the tires on ChatGPT, running small pilots.
Okay.
Now they are baking these models into their daily workflows.
So they aren't just playing with it anymore, they're actually running their businesses on it.
Correct. And that requires massive, massive computing power. Every time an AI model runs a query, the meter is running on Azure. That volume is what's driving this acceleration.
So the revenue story is solid.
Mm-hmm.
But let's talk about defense. We always hear about Microsoft's moat.
Mm-hmm.
In plain English, what stops a company from just switching to Google or Amazon tomorrow?
It's the plumbing problem. Think about it this way. If you're a chief information officer, a CIO, and your company uses Microsoft 365, Teams, and Azure, that isn't just software.
Right.
That is the electricity running your entire office.
So switching isn't just like deleting an app.
It's ripping out the drywall. If a CIO decides to switch away from Microsoft, it costs millions of dollars, it disrupts everyone's work, and if something breaks during that transition, they get fired.
That sounds terrifying.
It is. Staying with Microsoft is the safe career choice. That creates what we call high switching costs. It's not that the product is impossible to replace, it's that the pain of replacing it is just too high.
And then you layer on the network effects. I saw the user numbers in the report. LinkedIn has 1.2 billion members. Teams has 350 million monthly active users.
And don't forget GitHub. That's where the developers live, over 20 million users on the Copilot platform alone. The more people use these tools, the harder it is for anyone to leave the ecosystem.
It becomes the standard language of business.
Exactly. If everyone you work with uses Teams, you kind of have to use Teams too.
There's one other barrier to entry that really stood out to me in the report. The sheer cost of competing. Microsoft is spending over $64 billion a year on CapEx.
And let's define that quickly. CapEx in this context means building physical things, data centers, servers, fiber optics, and buying all those expensive chips.
$64 billion. That's more than the entire revenue of most Fortune 500 companies.
That is scale as a weapon. If you want to compete with Microsoft today, you can't just write good code. You need 400 data centers globally and a spare $60 billion annually just to sit at the table.
Wow.
That effectively bans almost everyone on the planet from competing, except maybe Amazon and Google.
It's like trying to start a new railroad company. You can't just buy a train. You have to lay the track across the entire continent first.
Exactly. It's an insurmountable barrier for a startup.
But spending $64 billion brings us to the cost of doing business. It's not all sunshine and rainbows. Spending that much money has to hurt the wallet eventually.
It does, and this raises a concern about their profitability margins. Revenue is growing at, let's say, 16%, but the cost of revenue is growing closer to 19 or 20%.
So it's getting more expensive to earn each dollar.
Yes. AI is expensive. It's thirsty for power. It needs complex water cooling systems. And those NVIDIA chips, they cost a fortune. It costs money to make money in this new era, and that compresses the profit margin, even if just slightly.
Aside from the power bill, the report highlighted a specific strategic weakness that I hadn't really considered before. They call it the mobile gap. How big is a deal is this, really?
It's a critical vulnerability. Microsoft owns your desktop at work, they own the server room, they own the cloud, but they do not own the device in your pocket.
Right.
They have no mobile operating system.
They completely missed the boat on that one. Windows Phone didn't quite make it.
Right. So now, if they want to get their AI agents onto your phone, they have to go through Apple or Google.
And that means?
That means they have to pay the App Store tax, that 15 to 30% cut on transactions. And more importantly, they have to play by Apple and Google's rules.
Ouch.
For a company that loves to control the entire ecosystem, relying on a direct competitor to reach the end user is a dangerous exposed flank.
It's like owning the water company but having to pay your neighbor to use their pipes to get it to the house.
And your neighbor can change the price or shut off the valve whenever they want.
Then you have the usual suspects for risks: regulation and the economy.
Always. The EU and US antitrust regulators are watching every single move Microsoft makes, and macroeconomics is simple. If the economy slows down, companies fire people.
Fewer people means fewer office subscriptions.
It's a direct hit.
Okay, let's shift gears to the part everyone is waiting for. We know it's a good business, but is it a good stock? The report runs Microsoft through a Buffett-style checklist. How does it score?
We look at two things, quality and price. On quality, it's a slam dunk, an A+.
Run me through the highlights.
Okay, first, cash flow. Free cash flow is positive every single year. Their FCF margin is between 25 and 30%.
Which is elite.
Absolutely elite. It means for every dollar they bring in, they keep 30 cents in pure cash.
And profitability.
Gross margins are near 69%, net margins around 36%, and their return on equity, which Buffett loves because it shows how efficient management is with our money, is over 30%. These are just stellar numbers.
What about the balance sheet?
Fortress-like, their debt-to-equity ratio is 0.13. Meaning they have almost no debt relative to their size. They have more cash on hand than total debt. If the economy collapses tomorrow, Microsoft isn't going bankrupt. They would probably be the last survivor.
So it is, by definition, a wonderful company.
Without a doubt.
Okay, so quality is an A+.
Yeah.
But here comes the fail grade, the price.
Yeah. This is where the math gets a little ugly. The report shows them trading at a PE ratio, price to earnings, of around 33 to 37.
Break that down for us. What does a PE of 37 actually mean?
It means you are paying $37 today for every $1 of profit the company makes. Or, another way to think about it, if profits stayed exactly the same, it would take 37 years for the company to earn back the money you paid for the stock.
That seems like a really long time. What does a value investor usually look for?
Historically, someone like Benjamin Graham or Buffett preferred that number to be under 15, maybe 20. So 37 is almost double the traditional value standard.
So we're paying a huge premium.
A massive premium. And if you look at the PEG ratio, which compares the price to the growth rate, it's over 2.0.
Remind us what the PEG ratio tells us.
It helps us see if the high price is justified by high growth. If a company has a PE of 30 but is growing at 30%, the PEG is 1.0. That's fair. But Microsoft has a high PE and lower growth than that, so the PEG is over 2.0.
And anything over, what, 1.5 is usually considered expensive?
That's the rule of thumb, yeah. It signals expensive.
So, high quality, but very high price. It's like buying a Ferrari, but paying double the sticker price.
Exactly. It's a great car, but is it a great deal?
To figure that out, the report did some crystal ball work with a few discounted cash flow scenarios. What is the stock actually worth based on the cash it generates?
They ran 3 scenarios to find the intrinsic value. Scenario 1 is the no-growth apocalypse.
What happens then?
If Microsoft just stopped growing today, stayed exactly as profitable as it is right now forever, the stock is worth maybe $112 to $145.
And it's trading around $480.
Right. So about $300 of the current share price is purely hope. It's the market betting on future growth that hasn't happened yet.
Okay, let's be more realistic. Scenario 2, conservative growth. Let's say the cloud market gets saturated and they only grow 3 to 8% a year.
In that case, the value is somewhere between $154 and $412.
Yeah, so even at the high end, $412, that is still below the current price of $480.
Yes, that's the danger signal. Even with decent, steady growth, the stock still looks overvalued right now.
So to justify paying $480 today, you basically need everything to go perfectly.
That's scenario 3, the AI bull case. You need them to grow at 14 to 15% every single year for a decade. If they do that, the stock is worth maybe $582.
So there is some upside, but it requires a full decade of double-digit growth for a company that is already this massive.
Exactly. You are paying for perfection. There is no margin of safety. If they stumble, if AI slows down, if regulation hits, the stock has a long, long way to fall.
You're betting that the AI bull case is the only possible outcome.
Yeah, that's the takeaway. You are paying a premium for certainty in a very uncertain world.
Let's pivot to the people holding the rope. Who's running this show?
You have Satya Nadella. He's the CEO who took over from Ballmer and just completely turned the culture around. He's the one who shifted them hard into the cloud.
And his interests are aligned with shareholders.
Oh, yeah. He holds about $430 million in stock, so he wants the stock to go up just as much as you do.
And Amy Hood, the CFO.
She's the discipline steward. She's the reason their margins are so consistent, even while they're spending billions on AI. She manages the checkbook very, very tightly.
And they treat shareholders well.
Very well. They've paid and raised dividends for 21 years straight. But the real story is the buybacks. They have returned $364 billion to shareholders over the last 10 years by buying back their own stock.
Wow. Who's ahead of them?
Only Apple has given back more cash.
Now, I saw a fun detail about the founders in the report. A bit of a gossip column moment.
Yeah, the tale of 2 founders. It's fascinating. Bill Gates has been selling his stock for years to fund his foundation and other investments. He actually owns less than 1% of Microsoft now.
But Steve Ballmer,
the former CEO. The guy famous for running around stage, sweating and screaming, developers, developers, developers.
I love that video.
He held on. He didn't sell. He is now the largest individual shareholder with about 4% of the company. He's collecting billion-dollar dividend checks every year just for sitting tight.
It's a testament to patience. Sometimes the best investment strategy is to just do nothing.
In his case, doing nothing was worth billions.
So let's wrap this all up. We've got a financial fortress, a massive moat, but a total nosebleed valuation. What's the verdict?
Microsoft is arguably the highest quality company on earth. It checks every single box for a wonderful business. But the stock price, it assumes that AI is going to change the world and that Microsoft will capture all of that value. It's a bet on aggressive, uninterrupted growth.
It feels like they're building the railroads for the next century, but the ticket price to get on the train is just incredibly steep.
That's the perfect summary. If you buy now, you aren't buying a bargain. You're buying a front row seat to the AI revolution, and you are paying full price for the ticket.
I want to leave you with one final thought, something to chew on. We mentioned Microsoft is spending $64 billion a year building these AI factories. That's a lot of concrete and silicon.
Right. They're building the capacity.
But here's the provocative question. Will the customers, the businesses, actually buy enough AI subscriptions to pay for all that infrastructure. We're building the hotel, but will the guests actually show up?
That is the multi-billion-dollar question. If AI monetization lags even slightly behind that spending, or if businesses just decide, AI is cool, but maybe not worth the cost, then that premium stock price has a long way to fall.
Something to think about next time Copilot writes an email for you. That's it for this deep dive into the Microsoft empire. Thanks for listening.
Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. The content is for educational purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership or subscribe us on Apple, Spotify podcast channel, Deep Value Investing and deepvalues.ai.
See you next time.